Good day, fellow investors. We discussed Nike this Monday, and of course there was a barrage of comments asking about DEC. Because the stock is also down, as is the whole environment. However, there seems to be a lot of value. If I look at your comments here, all great brands, great financials, great fundamentals, great growth, all growing better than Nike, so no debt, still a long runway ahead, which means we need to take a look at what's the real fundamental value of DEC. When you look at this stock price going up and down, I'm sure of one thing: the market is surely wrong. Let's see whether it's on the downside or on the upside. By the way, this is what I do. I constantly look at businesses. I'm looking for low risk, high reward, value investment businesses. And if you want to build part of your long-term wealth with value investing, check my research platform in the link in the description below. The goal is for me to find 10% or higher business returns, and that's also how we'll compare Deckers here, with low risk. Let's discuss the business. And immediately the first slide of the business is what makes life difficult also for Nike. Because the brands there are very, very competitive. On top of everything, there is also Brooks, Charlie Munger, Warren Buffett branding style that I bought not even knowing that it was Berkshire's brand. What do I know about shoes? However, Warren, despite me talking about Nike and Deckers, I'm staying true to Berkshire. I know Warren is watching, so he's now retiring, and you don't want to piss off a retiring person. Anyway, all great numbers. This is the key. Profits going from 100 to 1 billion. That's a 10x. What happens to the stock when that happens? A stock becomes a 10x. If you can find these kind of investments, if you can find them here, no matter what price you are doing, you will do okay. So that is the key. That's also something what I'm searching, but it's not that easy, especially not in this environment. Revenue still growing 10%, also guidance 10% growth going forward on revenue. Funny thing, if Nike would grow at 10%, it would have a P ratio of 40. Not like Deckers 12. But earnings are expected to be flat. Of course, they also compete in the same environment. If Nike is reducing inventory, destroying their margins, practically making no money on their inventory, so that is also hitting DEC. If we look at the conference call, they say there is tariffs also impacting, so that might also squeeze margins a little bit. But DEC's focus is, to answer the question there, to focus and grow those margins. Wholesale, direct to consumers, where you can get money. Analysts always ask these short-term questions, but the key here is long-term brands, and Karotti says premium brands, and premium brands is what has more elasticity in this market, which is also showing with their strong profits. Book health, things like that. So they just keep on doing what they are doing. However, what I want to focus is sentiment analysis. And if you look at here, of course, everything was going great. And also AI tells us here that was very confident in the previous conference calls, but now adopted a more cautious stance during AI, shifted from emphasizing momentum and outperformance to more measured optimism. Of course, you can get, let's say, a bit more exuberant when things go that well. Okay, so my opinion on Deckers is that this is a highly competitive environment. It has flown high, perhaps a little bit too high, and now it's back to the deck. However, we have to see, okay, where is the value? The market is crazy irrational, will always overshoot on the upside and overshoot on the downside, and that is where we can find value opportunities. If I look at this, I remember also Skechers, P ratio of 7, I've been following it, and then you get, this is the real value, private equity, let's say a 7% free cash flow yield, they would buy also Deckers. If there is growth of 10%, I think fair value would be a P ratio of 20, not 12. So in this case, maybe this was overshooting, but perhaps the trend is there, and now we are undershooting that trend. Of course, the risk is same story here, that's why the market is so concerned. That's why you see this great volatility, because also this can happen when the growth stalls. It's just a slippery slope downward. And when will this come? It's impossible to know. When will another brand become cool? Consumer preferences are fickle, and that is also how you have to see it from a portfolio exposure. If you have a higher portfolio exposure here, then you are gambling, because nobody can know with precision. You can just play the risk and reward. You have to expect volatility, and then you have to try to gain from that volatility, and always fundamentals help there, even if those fundamentals can also be fickle. They're doing buybacks. What is that? Let's say 5-6% buyback yield, good business cash flows. 5% buybacks, if they keep on organic growth of 5 to 7% over the long term, that's a 12% return, all else equal. When they just turn to growth, the market will like it again, P ratio of 20-25, and boom, you have your return, like we discussed with Nike. If the growth is at 10% for a year or two, that's a 15-20% return, perhaps even higher. P ratio of 25, that's a double in a year or two. So I have put Nike here from an absolute investing perspective, here from a relative investing perspective. So this is the yield, this is the potential on the risk and reward. Deckers, given the lower fundamental valuation, higher growth, better, perhaps more niche market positioning, I would put it here at a risky 10 higher percent. Also, if there is whatever improvement, as here analysts show it to improve, you are quickly up in the 130s for a great return. Again, Nike also, if they can turn around, perhaps there is a better growth story here with DEC that is competing with Nike. So might be, again, interesting from a risk and reward perspective. However, you always ask for my opinion. Here is my opinion. It's a highly competitive environment. The consumer preferences are always fickle. There is high volatility, which means also in fundamentals, which means I can't hold on to something. Yes, if they keep on growing at 10%, the stock will follow. If not, and I simply don't like these kind of risk and rewards. I want more certainty when it comes to investing. What can I say? I'm that kind of investor. So nothing wrong with the company, just not my cup of tea. So Nike and DEC will not be followed on my quadrant. Keep in mind the volatility, the fickleness, adjust your portfolio exposure to that, and that's the maximum value I can give you. What will the environment look like 2 years from now? I've worked in fashion, yes, so I know that nobody knows that, and therefore that is also something to apply when it comes to investing there. Thanks for watching. I'll see you in the next video.